the investment industry recently came together for the MorningStar Awards, which were hosted on Tuesday evening in Cape Town. Besides awards for each fund category, MorningStar also announced the best small and large investment house overall. The award for the best large manager went to Coronation, while the award for the best small manager went to Southern Charter Wealth Management. This is also not the first time you've won an award at the MorningStar Awards, as far as I'm aware. I think for the benefit of viewers, could you just tell us a little bit more about some of the funds and strategies that Southern Charter Wealth Management run?
This is actually the second time we've won this award, and earlier in the month we won 2 awards, Raging Bull Awards, for our balance and our growth funds. But our process has essentially been, we are top-down managers, we're asset allocators. So our focus is on asset allocation as a major generator of alpha. We have 3 funds, which are defensive, balanced, and growth. It's incredibly simplistic, and we follow Markowitz's models that have been, the numbers have been crunched, and I jokingly say 2 or 3 in 2007, 2008, when I wasn't sure what was going on with the numbers. Everybody thought it was a bit humorous and funny, and I thought, well, I have to protect my clients' money. How do I do that? Well, let's apply the Markowitz principles with the strategic asset allocation models. And during the last 5 years, the challenge has really been to keep the fund managers actually on the models, because people often thought, or fund managers often thought, they knew things better than the market. So we do tactical asset allocation on top of the strategic asset allocation, and it's actually delivered incredibly consistent return on a risk-adjusted basis. I mean, our clients are absolutely delighted.
I'm sure.
By absolute contrast to Coronation, we are top-down and they are bottom-up. And I guess some of the fund managers, we use actually Coronation's income fund in our funds. But most of the managers that we selected had a global view. So we could see 2007, 2008, the macro picture was going to play out quite hugely in South Africa. We didn't realize at that time, to the extent that it has played out, with the compression of the yields and people chasing both our bonds and our high yield dividend stocks, that actually, and we were just positioned correctly. The second thing that we did was we chose, I mean, the first line of defense was to make sure the strategic asset allocation was right. The second was then to choose value fund managers which we believed had potential. 2007, 2008, we actually changed from Investec to Foot. And as the market was crashing, we thought, well, we'd get more protection, and we've had an unbelievable return. So our job is really making sure that the asset allocation is correct and choosing the correct fund manager to play in each asset class.
Mark, just to come into that asset allocation question, and we talk about the offshore exposure. You know, I've spoken to many investment managers who from South Africa who are just not interested in what's going on in the fixed income space offshore. Is there still a case to be made for keeping the fixed income component in an offshore portfolio at this point, or how are you managing the risks and the challenges in that sector?
We realize that in our models, the historic models tell you should hold in a balanced portfolio about 8% in offshore bonds, but we're actually down to 1%. I think that you're in a real danger zone being in offshore bonds. I think the markets, our view is that they have turned. Things are looking better than they were, and we're not facing down a financial Armageddon. I mean, I'd be very surprised if they could go much further than what they are now. In fact, the 10-year US Treasury bond as an indicator is up at 1.88. We watch that very carefully as a sort of a long-term view of where things might end up. And I think we're on the positive side rather than the negative side. I think bonds have had an incredible run for the last 20 years. And it's now going to be the position of the timing of this sort of almost great unwind where people have had anything that's related to fixed interest that has had a huge advantage might have a problem going forward.
As a small investment manager, you're obviously top down. What are some of the things that you look for in an investment manager before you include them in one of your portfolios?
We actually, it's a very interesting point. The sort of key criteria is we look at the individual manager and his ability to move between the top down and the stock picking role. We find sometimes with incredibly bright guys, they get fixated on believing their own story, and they won't look left or right. And after you've visited 5 or 6 managers, you get a fair idea of what the consensus is, and you may find somebody down the completely wrong track. So its ability to have an open mind, follow a really solid process, and probably amongst the biggest issues being consistent. You don't really want people to take excessive risk with your money, and you want them to give a consistent risk-adjusted return. That's what we're looking for.
And besides just consistent theme, do you ask the question around how much of an investment manager has his own wealth invested in the funds he invests in? Is that alignment of interests quite important?
It's probably not as important, but where it might come in is in terms of the size of the funds. I know these are issues. We held Allan Gray 5 years ago, and we held Coronation's funds 5 years ago, and what we've been looking for is smaller funds, and by definition the smaller funds tend to have closer management involvements and probably larger investments from those individual managers. I think when you get a bigger corporate type operation, the decision making might get more diluted. Whereas that's quite a core issue. We definitely don't want decisions made by committees. We're looking for individuals who are in a growth phase, who have an interest and a focus in managing that money as if it was their own. And I'm pretty sure we don't actually ask how much they've got involved, but there's an assumption that they would be fully involved in their own funds.
Okay, great. Mark, I'll have to leave it there. Thanks very much to Mark.